even more concerning when I look at household sentiment. So households are terrified right now. They're the most terrified they've been since. The issue right now is inflation. This is the thing that everybody's talking about and everybody's fearful of. Is we've never seen inflation like this, well, not since the 1970s. So if you look at the chart of CPI now, you can see we're at levels of 8%, which is something we can't get our heads around in this apparently deflationary or disinflationary world. How did this happen? Was this the money printing? Now, I've talked at length about this in other Real Vision content and written a lot about it in Global Macro Investor and Macro Insiders. My view is that the persistent inflation of the 1970s that you can see on this chart was actually driven by demographics. When the baby boomers came into the population in the largest number in history of, let's say, 30-year-olds all buying their first house, first car, and everything else together, we had a demand shock. We also had supply shocks as well from the Arab oil embargo in 73, 74, and then going into the Iran crisis in 79. So we had a double. We had a massive demand shock and a massive supply shock. This time around, I think it's different. Actually, the pandemic had shut a lot of things down. So that was the supply shocks of trucking and moving goods around and manufacturing, and factories weren't open. And so you had to bid for higher prices to get stuff. And then there's the issue of underinvestment in commodities themselves. So what's happened is, as the world's reopened, we don't have enough ability to produce commodities at scale. Then we throw in the Russian crisis, the war in Ukraine, and we've taken commodities out of the market. Created this very heady mix that is really scary right now for everybody. The world is about to change towards low growth and inflation coming down, and what that might mean to you, your portfolio, the economy, and to asset markets. So the next chart I've got is the year-on-year rate of change. Everything in financial markets is about rate of change, it's not levels. Now, the rate of change of inflation is still going up, but commodity inflation has been going down and fast for a period of time. That will feed through to CPI. So this is the all commodities year on year. But one of the things we've been talking about is food commodities. So the food commodity chart, people have been talking about global food shortages. And I don't really have time in this piece because it's going to take a lot of time to get through what I've got to get through. But that's not 100% dyed in the wool. I'm going to be speaking to people like Dwight Anderson to figure out, okay, how scary is the food situation? Could we end up with global food shortages? We're going to end up with some shortage for sure. A lot is going to depend on this harvest in the West, and also whether they use food as a weapon against Russia or not. But the year-on-year rate of change is coming down. And that means that CPI is going to come down. Doesn't mean your food price is going to get cheaper, but it means the rate of change becomes less shocking. The other part was the supply chain issue that created inflation. And supply chains are starting to ease everywhere. Now, we have a situation in China that, again, makes this world bloody complicated because we don't know how long the Chinese situation with COVID and the shutdowns are going to last, and what it actually means, whether those pictures of all the ships in the ports of Shanghai are going to create supply chain issues or whether they're more normal. You know, again, we can't really get all of our news flow from Twitter. We need to do the homework on it. And when I look at, for example, in the US rail car loadings, you see this chart, rail car loadings year-on-year rate of change have collapsed. And so that's telling us that the supply chain issues have been resolved and we're back to some normality. In fact, significant weakness. These rail car loadings are weak enough to suggest that the ISM should be well below 50. Now, is that going to be the case? I don't know, but I'm going to show you evidence why the ISM may do that. The ISM, for those of you who don't know, is the Institute of Supply Management survey, which basically is my guide to the business cycle. It basically is a lead on GDP, or it's essentially real-time GDP. And if the ISM crosses below 50, then growth is around 1% in the US economy. Once it gets to about 47, it suggests the economy has stalled and we're close to recession. So 47 print has usually given almost 100% of the time a recession. So shipments back to normal. So they're suggesting that the ISM should be back down at 50, which is basically very slow growth, which is what I think the trend rate of growth of the US economy is with an aging population and high debt. I think trend rate of growth is closer to 1% than it is to 3%, and that we're going to see that moderation inflation. And that's what freight shipments are telling you. These supply chain issues caused a behavioral change in manufacturers. What they started to do was build inventories. And inventories meant that they had goods to sell even if they couldn't get goods into the country. So everyone was forced to hold longer inventories. Now, inventories increase GDP growth. But when you draw them down, i.e. you start selling your inventories and not importing goods, is what you find is GDP growth falls. Now, if you look at the next chart of ISM inventories, these people are saying that their inventory levels are about as high as they've ever been. They've built inventories, and that was a rational thing to do. But if demand slows, then you've got an inability to sell inventory. And you can see the next chart, which is the ISM versus ISM new orders, less inventories. And here, this is leading, and this is a great indicator I've used over the years. It really works well. It's suggesting that the level of inventories is too high compared to the new orders coming through. And we're going to see inventory liquidation over time. And that is suggesting the ISM is going to come below 50. Now, it's not turned around yet. So this could be an ongoing situation. We don't know yet. Are we headed to recession or are we headed to a growth shock? You see, inflation, yes, it's driven by supply issues, but inflation really is driven by demand. If you take demand out, then there's less demand for those goods fall in price. The likelihood, I think, is that CPI comes lower than the market expects. And that will be driven by this demand destruction I'll come onto in a bit. And I think that is the thing that most people aren't looking at. Most people are looking at the supply equation and assuming stable demand. That's generally how most of the models work for the commodity people and the economic forecast. I look at business cycle because I find the cycle is predictable, because generally as the cycle turns and goes lower, it follows all the way through until it turns back up and goes higher. You have many times where you have the cycle gets down to almost zero growth and comes back up again, driven by fiscal stimulus. And I'll talk about that period, particularly in the 2000s, where we saw that a number of times, and why that happened, because it's going to have impacts for us in this discussion today. But what I've said to people is you need to understand what higher prices does to people. If you're not raising wages, or you can't raise prices as a corporation, the high prices that you've got are demand destruction. They're a tax on consumers and businesses. Gas prices at the pump in the US. We could use nat gas in Europe. There's a bunch of these things that are exploded. Food prices exploded. And what that means that these consumers have had to pay a tax. Their discretionary income has been more used now for the basic goods and services that they've needed. We've seen this in the past when healthcare costs exploded or schooling costs exploded. Both of those are moderated in recent years. But this is a shock that means people spend less on other stuff. We've seen stuff like restaurants rolling over because of stuff like this. Even more concerning when I look at household sentiment. So households are terrified right now. They're the most terrified they've been since 2008. And I can understand why. You've raised the cost of everything. You've taken away the fiscal stimulus, and people just don't know whether they can cope with this situation. I mean, don't forget, household disposable income in the US, there may be a lot of assets, but people live paycheck to paycheck. They live on credit, and we've seen credit going up and savings going down to try and counteract these high prices. These high prices are extremely recessionary on the consumer, and I think we're going to see more and more of this. It's not just the US. You've got these aging population, and older people have fixed incomes, i.e. they've retired, they've got a pension. You raise the cost of living on them, it kills them. And I think this is not something most people are factoring in, is the demographic composition, the debt composition, and then adding higher prices is extraordinarily difficult. And to express this in different terms, look at real incomes. I mean, Jesus Christ, real incomes have collapsed because they're negative because of the inflation rate, and wages haven't gone up as much. Wages have gone up. But again, you need to remember that wages have gone up for those in the workforce. We have a labour force participation rate that's been falling due to demographics for decades, and I've talked a lot about that in the retirement crisis videos and many other videos, and written about it a lot over the years. Those people don't bid up wages, they've retired. So they just take the hit to their income. Those people who are in the workforce have got higher incomes, but it's not as much as inflation as the chart shows you. If it's not as much as inflation, that is discretionary spending coming lower. The older generation just got killed, full stop. So net, even with the increase in wages, the total demand in the US economy has not gone up. So I think people are only looking at one equation, which is the wages have gone up. They're not looking at that real wages are still negative, so they don't catch up enough, and they're not looking at the fact that those wages only account for something like 50% of the population, because the rest are out of the workforce. Mortgage rates have exploded. We're back to kind of 2006 levels now, and also 2010-12 levels. We've just had, as this chart shows, the largest rise in mortgage rates in history. So we've been inflating people, we've been taxing people due to the inflation, we've taken away their fiscal stimulus, and now their mortgage costs have exploded just when everybody bought new houses over the pandemic. This is not good. This takes away discretionary spending from the economy. An amazing fit. And this goes back for the entire history of the S&P. It's always been an amazing fit. Equities are cyclical. All assets are pretty much cyclical. And so what it's saying is the S&P currently, and today we're at 4,200, that is suggesting that the ISM is going to get down to 50. If we break lower, and again, I can't tell what this week is going to do, but we're in a very kind of precarious setup where we could see another 20%, 10%, 15% downside in the S&P. Now that would start suggesting that the ISM is going to start going below 47, which is recession. The dollar is a global wrecking ball. When the dollar goes up, the business cycle goes down. And when the business cycle goes down, the dollar goes up. It's a feedback loop. It's not just about interest rates. People get it so wrong. Interest rates are a part component in dollar. Interest rate differentials are a part component. Flow of funds, M&A activity, all sorts of things go into what drives the dollar. But the business cycle and the dollar are highly correlated. And the dollar is telling you that the ISM is going to see some sharp falls coming into the summer, and that the narrative is going to shift very quickly from, oh my God, inflation, to, oh my God, growth is slowing. And then it's going to morph, much like 2008 did, is forget about inflation, look at growth. And then, oh, inflation's coming down as well. Oh, we need to stimulate. Those are the paths that we get to. Whether we get all the way down there, we'll talk about that in a bit. But I think there is a decent probability.